In today's world, building long-term wealth is crucial. Mutual funds have emerged as a popular choice for many Indians, offering a way to achieve financial goals and combat inflation. But with a vast array of mutual funds available, selecting the right one can be daunting. Let's explore two prominent types of equity mutual funds: multi-cap funds and flexi-cap funds. Understanding their distinctions will empower you to make informed investment decisions, and by the end of this video, you'll have a clear understanding of the differences between these funds and which one might be more suitable for your investment goals. So, let's get started. Multi-cap funds diversify your portfolio by investing across various market capitalizations. Large cap companies, represented by the blue section, are the biggest and most established, offering stability. Mid-cap companies, represented by green, have the potential for significant growth, while small-cap companies, represented by yellow, hold the most growth potential but also carry the highest risk. Multi-cap funds are mandated to invest a minimum of 75% of their total assets in equity and equity-related instruments. They must also allocate at least 25% of their portfolio to large-cap, mid-cap, and small-cap companies, as per SEBI regulations. This diversification is a key strength of multi-cap funds. By spreading investments across market caps, they help manage risk. If the performance of one market cap falters, the others can potentially offset those losses, promoting a balanced approach. Another benefit of multi-cap funds is their potential for improved risk-adjusted returns. The fund manager actively monitors market conditions and can adjust investment allocations strategically. This dynamic approach aims to balance risk and potentially enhance returns over the long term. Multi-cap funds are actively managed by experienced professionals. These fund managers leverage their expertise to select stocks across market caps and make strategic adjustments to the portfolio as market conditions evolve. This professional oversight offers peace of mind for many investors. Flexi-cap funds offer another compelling option for investors seeking diversification. Similar to multi-cap funds, flexi-cap funds invest in companies of all sizes. However, they boast greater flexibility in how they allocate their assets. This adaptability allows them to navigate market fluctuations more strategically. Flexi-cap funds must allocate a minimum of 65% of their total assets to equity and equity-related instruments. Unlike multi-cap funds, they have the flexibility to invest across market capitalizations without any specific mandate. These funds invest in a diversified portfolio of stocks from companies with various capitalizations, without being restricted to any particular allocation percentage. During market downturns, flexi-cap funds can leverage their flexibility to reduce exposure to volatile small-cap stocks. This helps mitigate potential losses and protect your investment. The adaptability of flexi-cap funds empowers them to seize opportunities across different market cycles. By strategically adjusting their allocations, they can potentially outperform stagnant investment strategies. Now, the crucial question: which fund is the ideal choice for you? Multi-cap funds cater well to investors with a moderate risk tolerance seeking long-term capital appreciation. The emphasis on diversification and professional management offers a balanced approach for long-term wealth creation. Flexi-cap funds, on the other hand, may be suitable for investors comfortable with a more aggressive approach. The flexibility in asset allocation allows them to potentially capture higher returns during market upswings. However, this flexibility also comes with a slightly higher risk profile. Regardless of your choice, remember that mutual funds are long-term investments. It's crucial to understand your financial goals and risk tolerance before making any investment decisions. Consulting a professional financial advisor can be extremely beneficial. They can assess your unique financial situation and recommend investment options aligned with your goals and risk profile. By carefully considering your options and seeking professional guidance, you can embark on a well-informed investment journey using mutual funds. Remember, consistency and a long-term perspective are key factors for achieving your financial goals. Thanks for joining us today. If you enjoyed this video, be sure to like and subscribe for more informative content on all things finance. See you next time.